If you want to lose money in Singapore real estate today, just follow the old playbook, buy a condo.
Yeah, it sounds completely crazy, but the smartest investors in the market just dumped $15.4 billion into Singapore property.
And that's just in the first quarter of 2026 alone. Plus, almost none of it went into traditional residential homes.
Right. I mean, that figure represents an absolute structural upheaval. We are looking at like an astronomical 166.5% increase in investment sales volume year over year.
It's massive.
It really is.
Really.
The capital isn't just growing, well, it is fundamentally changing direction.
And that is exactly our mission for today's deep dive. We're tracking where that $15.4 billion is actually flowing. So if you're an investor looking at Singapore right now, you need to tune out all that mainstream residential noise.
Absolutely.
The strongest signal in the industry data this week points to a massive, aggressive capital rotation. The smart money is basically abandoning generic, replaceable assets, and they're sprinting towards scarce, yield-generating commercial and industrial properties.
But before we break down the actual mechanics of this rotation, we do need to establish the baseline rules of engagement for you, the listener.
Right, the mandatory disclaimer.
Exactly. Everything we discussed today, from capital appreciation to rental returns and financing spreads, it all relies on indicative and historical market data.
Yields are never guaranteed.
Never. This deep dive is designed purely to provide you with general market information and industry data. It is absolutely not financial advice.
With that understood, let's look at the death of the old playbook. For decades, the default strategy for wealth accumulation in Singapore was incredibly straightforward.
You make some money, you upgrade your HDB to a private condo.
Right. And then you make a bit more, you buy a second condo for investment.
Yeah.
But the data shows capital is now actively fleeing that space.
And the catalyst for that flight is the ABSD, the additional buyer's stamp duty. We've basically reached a point where the policy friction has created this insurmountable wall for pure investment capital.
Yeah, the numbers are just brutal now.
They really are. Like if you are a foreign investor looking to buy residential property in Singapore today, you face a 60% stamp duty right out of the gate.
Wow.
And even for a Singapore citizen buying a second residential property, it's a 20% tax.
Which is just incredibly punitive. I mean, think about it, like starting a new business. If you're a foreign buyer, the government is essentially confiscating 60% of your startup capital on day one.
Before you've even opened your doors.
Exactly. Before you made a single sale, the math simply breaks down.
Oh, it completely shatters. And the damage is compounded when you look at the current yield gap. Right now, if you look at prime residential properties in the core central region, the CCR gross yields are just languishing, somewhere between 1.5% and 2.5%.
So you are paying a massive premium up front to secure a return that, barely beats inflation?
If it beats it at all, honestly. Yeah. Conversely, if you look at industrial strata properties, those are generating anywhere from 4% to 6% gross yields.
Okay, let's pause on strata properties for a second, just to make sure we're totally clear on the terms.
Sure.
A strata property, in this context, basically means you don't have to buy the entire industrial warehouse or, the whole business park. You're buying the title to a specific individual unit within that larger industrial complex.
Right.
Much like you would buy a single apartment in a residential condo building.
That's a perfect parallel. You own the specific unit and you share the common facilities.
Yeah.
And here is the critical pivot point for investors.
Yeah.
Commercial and industrial properties attract 0% ABSD. 0%.
So an investor literally has a choice. A 60% tax penalty for a 1.5% residential yield.
Or a 0% tax penalty for a 5% industrial yield.
Right. When you frame it like that, the rotation isn't just logical, it's practically mandatory. But I'm curious, is this strictly foreign capital trying to dodge the stamp duty, or is local institutional money making the exact same move?
Oh, the industry data confirms this is a market-wide phenomenon. Domestic institutional capital is heavily involved.
Really? Like who?
Take CapitaLand Investment, for example. They just secured a $2.4 billion mandate from Income Insurance specifically to manage direct real estate.
Wow, $2.4 billion?
Yeah. That mandate essentially proves that heavyweight local institutional capital is aggressively targeting income-producing commercial assets. They are hunting for yield, but without the drag of residential policy friction.
Okay, so if the capital is rotating out of residential, it obviously needs a place to land. And Singapore is a highly constrained market geographically.
Very much so.
Where do you actually find a safe haven for billions of dollars that also offers scarcity?
Well, the ultimate scarce asset class in this market right now is freehold commercial properties, particularly conservation shop houses.
Oh, right. These are the beautiful heritage buildings you see walking around areas like Chinatown or Tanjong Pagar.
Exactly.
But beyond just looking nice, what makes them such a powerful investment vehicle?
It actually all comes down to urban planning. The Urban Redevelopment Authority, or URA, enforces incredibly strict conservation rules to preserve the city's heritage.
Makes sense.
Right, but from an investment perspective, that translates to an absolute cap on supply. The pipeline for new conservation shophouses is effectively zero.
Because they literally cannot build any more of them.
Precisely. And because they are zoned for commercial use, they sit squarely in that 0% ABSD safe zone we talked about.
It's kind of like the art market, right? You aren't just buying a canvas with some paint on it. You're buying a Picasso knowing definitively that the artist is dead and no new paintings will ever be produced.
That's a great way to look at it.
The scarcity itself basically becomes the primary driver of value.
And you can see the desperation to secure that scarcity heavily reflected in current transactions. Like, market analysts noted, a freehold URA-conserved shop house along Geylang Road was recently snapped up by a buyer before it even reached the auction block.
Wait, they bypassed the entire public bidding process.
Yeah, just to ensure they didn't lose the asset, they basically front-ran the entire market. The supply is really that constrained.
Unbelievable.
We're also tracking a pair of adjoining Kitchener Road shop houses that hit the market for $28 million. Those are offering estimated gross yields of 3% to 5%.
Okay.
Then there are assets like 237 Cantonment Road, which is this really rare freehold hospitality asset in District 2. It's listed at $17.8 million with a potential initial yield of around 4.5%.
So for family offices or ultra-high net worth individuals, securing a freehold commercial asset right on the fringe of the central business district it's the ultimate wealth preservation play.
Exactly.
But let me challenge the mechanics of that play for a second here.
Go for it.
We are looking at yields around 3% to 4.5% on these shop houses, but current borrowing costs are hovering around 3.8% to 4%. So if the cost of debt is nearly identical to the income generated by the property, where is the actual spread? I mean, are these buyers really making money, or are they just parking cash in a heritage building to hide from inflation?
That's a really fair question. But we need to look closely at how the debt markets are shifting in real time. The SRA, that's the Singapore Overnight Rate Average, which is the benchmark interest rate most commercial property loans are pegged to.
Right, the benchmark.
Yeah, that has recently dropped to 1.14%. And because of that drop, we are officially seeing the return of positive carry for leveraged investors for the first time since 2022.
Okay, break down positive carry for the listener in terms of like actual cash flow.
Sure. So let's say a bank takes that 1.14% SORA rate and adds their margin, bringing your total cost of debt to roughly 3.5%.
Okay, tracking.
If your shop house is yielding 4.5% in rental income, the rent completely covers the mortgage payment, it covers the interest, and it still leaves a 1% spread of pure cash flow in your pocket.
Oh, wow. So your leverage is actively generating income rather than draining your capital.
Exactly. But beyond just the positive carry, a lot of investors are buying these shop houses for their repositioning upside.
Meaning they aren't just holding them as is, they're changing them.
Right. You acquire an underutilized, maybe somewhat outdated office space. You secure the necessary approvals, renovate it extensively, and transform it.
Transform it into what?
Like a premium boutique hotel, or a high-end medical clinic, or even a luxury co-living space. You aren't relying on passive market appreciation. You're actively forcing the value of the asset upward by fundamentally changing its utility.
So you're buying the raw material to build a much more lucrative business inside the shell of a heritage building.
Yes, exactly.
I see the appeal. But if we pull back to our central thesis, $17 million here and $28 million there doesn't really aggregate to $15.4 billion in a single quarter.
No, it doesn't.
To hit that kind of volume, we have to look at the heavyweights.
We do. And the bulk of that capital is flowing into institutional scale assets. So we're talking grade A offices in the CBD, advanced industrial parks, and the institutionalization of the co-living sector.
Okay, let's tackle the office market first, because there is a glaring contradiction here.
What's that?
Well, the global narrative for the last few years has been the death of the office,
Mm-hmm.
right? Remote work, hybrid schedules, massive tech layoffs.
Oh, sure.
Yet, according to the industry data, Singapore's CBD Grade A office rents just hit a 17-year high. Rents crossed $12 per square foot per month in Q1. How is that even possible?
It's wild, right? Furthermore, vacancy rates are incredibly tight, sitting at approximately 4.8%. Market analysts actually project another 5% rental growth by the end of 2026.
Wait, I have to push back hard on this.
Okay.
If global tech firms are slashing headcounts and big banks are streamlining their operations, they inherently need less space. And if companies are taking less space, total square footage demand should drop. So how does a shrinking spatial footprint keep the entire market vacancy at a razor-thin 4.8% while driving rents to a 2-decade high? It doesn't make sense.
You have to look at the bifurcation of the market. What you're describing, companies shrinking their footprints, is absolutely happening. A multinational might reduce its presence from 3 floors down to 1.5 floors.
Right.
But the critical factor is the flight to quality. They are abandoning older Grade B or Grade C office buildings completely. They take the capital they save from reducing their overall square footage and they deploy it to lease ultra-premium Grade A space.
Oh, I see. So the older secondary buildings are the ones sitting empty and absorbing the vacancy hit. Meanwhile, the top-tier buildings have a waiting list.
That is exactly the dynamic. Corporate tenants are moving into green-certified ESG-compliant buildings.
Environmental, social, and governance.
Right. They need to meet strict ESG mandates from their shareholders. And honestly, they need physical spaces, compelling enough to make employees actually want to commute. So the overall market demand might be shifting, but the demand for the absolute best office space is structurally undersupplied.
That makes a lot of sense. And what about the industrial sector? It's not nearly as glamorous as a glass tower in the CBD, but the numbers are staggering.
Yeah, the industrial sector is really the quiet powerhouse of Singapore real estate. It just recorded its 22nd consecutive quarter of rental growth.
22 quarters. That is over 5.5 years of uninterrupted rent increases.
It is.
What is driving a rent like that?
It's entirely driven by high-value, specialized manufacturing. We are talking about advanced semiconductor facilities, biomedical research parks, and most importantly, data centers.
Data centers are fascinating because they completely change the definition of industrial property. We aren't talking about a corrugated metal warehouse storing pallets of consumer goods here.
No, not at all.
A data center requires massive, specialized physical infrastructure. Heavy-duty power grids, complex liquid cooling systems, reinforced flooring for server racks.
And because those physical infrastructure requirements are so intense and honestly so difficult to secure zoning for, an existing data center becomes a highly defensible, high-yield asset.
Right.
Capital allocators are treating prime industrial logistics the exact same way they treat essential public infrastructure.
Which brings us to a really interesting intersection. Companies are paying top dollar for Grade A offices and advanced industrial spaces to attract top global talent, right?
Yeah.
But when those highly paid expatriates relocate to Singapore, they immediately hit a brutal residential rental market. Where do they actually live? That bottleneck seems to be driving the third major capital flow.
Which is the co-living sector, driven by that exact surge in expatriate demand and obviously the high cost of traditional apartment leases. Co-living has aggressively transitioned.
Transition from what?
From a niche boutique startup concept into a fully institutionalized asset class.
Yeah, we are seeing massive portfolio deals happening in this space.
Kaliwu, which is a major operator, they just launched a portfolio of 7 freehold living assets for sale at $218.5 million.
Wow.
And this is a regional strategy, too. The operator Weave Living recently partnered with Nuveen Real Estate, which is a massive U.S. institutional investor, to acquire a co-living asset in South Korea for roughly $16 million.
So institutional capital recognizes that co-living solves a fundamental systemic urban housing affordability problem.
Exactly. And it does it while generating diversified, stable yields from hundreds of individual tenants rather than relying on just a single corporate lease.
Okay, this is where we need to bring it back to the listener.
Right.
We've discussed $2.4 billion mandates, $218 million co-living portfolios, and $28 million shop houses. If you are listening to this deep dive and you do not have $28 million of liquid capital to deploy, how do you actually execute this strategy?
Yeah, because direct ownership of these assets is locked off to 99% of the investing public.
Exactly. So what's the play?
The mechanism for the retail investor is the S-REIT market Singapore Real Estate Investment Trusts. REITs offer a highly liquid route to gain fractional ownership of the exact same Grade A office towers, data centers, and suburban malls that the institutional giants are buying.
And retail investors have clearly identified this opportunity. The industry data shows retail investors poured over $300 million into S-REITs in just the first quarter of 2026.
They essentially bought the dip. They stepped in when REIT unit prices softened due to fears about interest rates remaining elevated.
So where exactly is that $300 million being deployed?
The capital flows indicate highly strategic targeting. In the industrial and logistics space, CapitaLand S, or CLAR, absorbed nearly $198 million in retail inflows alone.
Just them. That is an overwhelming concentration of capital into a single logistics vehicle.
It really demonstrates massive retail conviction in the industrial infrastructure thesis. Similarly, Mapletree Industrial Trust, or MIT, they are undergoing a massive portfolio pivot.
What are they doing?
They're actively selling off their legacy United States logistics assets, divesting to the tune of $575 million.
$500 million.
Yeah, and the strategy isn't just to hold cash. They are redeploying that specifically to fund the construction and acquisition of data centers across the Asia-Pacific region.
Oh, wow. They are completely re-engineering their portfolio. They aren't just landlords anymore. By pivoting to data centers, they are essentially becoming critical utility providers for the global artificial intelligence boom.
Exactly.
What about the other sectors?
Well, for retail exposure, Fraser's Centerpoint Trust, FCT, remains the defensive heavyweight. They exclusively target dominant suburban malls in Singapore. These are the complexes deeply embedded in residential neighborhoods where people go for groceries, healthcare, daily essentials.
Which makes the underlying rental income highly resilient, regardless of macroeconomic conditions.
Exactly. On the office side, CapitaLand continues to attract capital for its prime CBD assets, even as they navigate some near-term unit dilution.
And that brings up the most critical question for anyone looking at the REIT market right now. We see headlines about certain REITs cutting their distributions, the dividends paid out to shareholders, often due to dilution.
Right.
Are these retail investors acting as smart money, or are they catching a falling knife?
To answer that, you have to completely separate the operational health of the physical real estate from the unit dilution happening at the corporate level.
Okay, break that distinction down. Let's look at operational health first.
So operational health means looking at the actual buildings. Are the office towers empty? No. Occupancy rates across these top-tier REITs consistently hover in the mid to high 90s.
Right.
Are the rents they charge falling? No. As we discussed earlier, CBD office and prime industrial rents are actually growing. In fact, many REITs are experiencing strong rental reversions.
And just to clarify, a rental reversion means that when an old lease, say a 3-year contract signed back in 2023 finally expires, the new lease is signed at today's much higher current market rate. So the property is capturing the inflation of the last 3 years.
Exactly. That is a sign of immense operational strength. Look at AIM's APAC REIT. They recently posted a 4.1% increase in their distribution per unit, driven heavily by these positive rental reversions.
So the underlying physical assets are thriving.
They are.
But if the buildings are full and the rents are going up, why do the cash distributions to the individual shareholders occasionally drop?
That is the impact of unit dilution. To acquire new buildings and expand the overall portfolio, a REIT will often issue new shares to raise capital.
Let me put this in perspective for the listener. Imagine you own 10% of a highly profitable 10-unit apartment building.
Hey.
The REIT management decides they want to buy a second, equally profitable 10-unit building right next door, but to get the cash to buy it, they issue more shares to the public.
Right.
After the transaction, you might only own 5% of the new, larger 20-unit complex. Your percentage slice of the pie is smaller.
Yes, your percentage of ownership decreases. But the total amount of rent collected by the combined complex has just doubled. The critical factor is whether the management team deployed that newly raised capital into what we call accretive assets.
Meaning the new building generates more income per share than the old buildings did.
Exactly. If the new asset is accretive, The temporary sting of dilution is offset because the actual cash payout to your smaller percentage ultimately goes up.
That makes perfect sense.
The recent drop in distributions for some REITs was a mathematical consequence of issuing new shares, combined with a headwind of higher interest rates on their corporate debt.
But if you look at the fundamental real estate, you're buying into high-quality, fully tenanted properties at a significant discount to their historical valuations.
Right.
Well, let's pull all of these threads together and summarize the mission we established at the top of this deep dive.
Sounds good.
If you are navigating the Singapore property market in 2026, the strategy has definitively shifted. The $15.4 billion of investment capital proves that the era of blindly accumulating generic residential condos is over.
Yeah, the policy friction is too severe, and the yields are just too compressed.
So the new allocation playbook is entirely focused on hunting for yield and securing scarcity,
You have to follow the institutional capital.
which means rotating into commercial assets, taking advantage of 0% ABSD on industrial strata properties, recognizing the massive infrastructure value of data centers, and leveraging S-REITs to gain fractional ownership of the grade A assets that are physically reshaping the city.
And as you think about how that physical city is reshaping, I do want to leave you with a final concept to consider regarding the future of prime real estate.
What's that?
We talked about corporate tenants demanding green, ESG-certified buildings today. But as artificial intelligence integrates into our physical infrastructure, consider what happens to asset valuations when a building develops digital intelligence.
Digital intelligence. What does a digitally intelligent building actually look like?
It's a building that goes beyond merely housing tenants. It's a commercial asset with an operating system capable of independently managing its own microenergy grid to optimize those ESG metrics.
Wow.
It uses predictive algorithms to schedule its own physical maintenance before a component ever breaks. It autonomously optimizes the heating, cooling, and workflow patterns of the companies operating inside it.
That fundamentally alters the old real estate mantra of location, location, location.
It really does. Within a few years, the defining factor that separates a good commercial asset from a truly prime, institutional-grade asset might not just be its zip code or its proximity to a transit hub.
What will it be?
The ultimate premium might be dictated by the sophistication of the building's operating system.
So if you're tracking capital flows, you can't just evaluate them just in mortar anymore. You have to evaluate the digital brain operating the building. That is something to think about. Well, thank you for joining us on this deep dive into Singapore's evolving real estate market. We'll catch you next time.